The science behind momentum investing is rooted in behavioral finance theories. When prices rise, investor enthusiasm often increases, creating a self reinforcing cycle. This positive feedback loop drives the momentum effect in markets. This phenomenon is explained by several key psychological biases. Herding behavior causes investors to follow the crowd, amplifying price trends. Confirmation bias leads investors to seek information that confirms their existing beliefs. The disposition effect describes how investors tend to hold losing positions too long and sell winners too early. Academic research has provided empirical support for momentum strategies. Jagadish and Titman's seminal 1993 study demonstrated that stocks with strong past performance tend to outperform in subsequent periods. Their research showed that winner stocks continue to outperform loser stocks over 3 to 12-month periods, providing the academic foundation for momentum investing. Together, behavioral biases and empirical evidence support momentum as a persistent market anomaly that investors can potentially exploit. These behavioral and empirical foundations help explain why momentum strategies have remained effective across different markets and time periods. Momentum strategies come in several distinct forms, each with its own approach to capturing market trends. Price momentum focuses purely on price appreciation, typically over 3 to 12-month periods. This strategy identifies securities that have shown strong performance and assumes they will continue to outperform. Relative strength strategies compare a security's performance against a benchmark or peer group. This approach focuses on identifying securities that are outperforming their relevant comparison set. Earnings momentum targets companies with accelerating earnings growth. Investors following this strategy look for positive earnings surprises and upward revisions in analyst expectations. Cross-asset momentum looks at trends across different asset classes. This strategy allows investors to rotate capital to the strongest performing assets, whether they're stocks, bonds, commodities, or other investment vehicles. Each momentum approach has distinct characteristics, but they all share the same core principle: following established market trends rather than trying to predict reversals. This is what unifies all momentum strategies, regardless of their specific implementation. Successful momentum investors rely on specific metrics to identify profitable opportunities. We'll examine 5 essential metrics that momentum investors use to find winning trades. The Relative Strength Index, or RSI, measures the speed and magnitude of price movements on a scale from 0 to 100. RSI compares the average gains to average losses over a specified period, typically 14 days. When RSI rises above 70, the asset is considered overbought. When it falls below 30, it's considered oversold. Moving Average Convergence Divergence, or MACD, identifies changes in the strength, direction, and momentum of a price trend. MACD consists of 2 moving averages, a fast 12-day EMA and a slower 26-day EMA. The difference between these lines forms the MACD line. A 9-day EMA of the MACD line creates the signal line. When the MACD crosses above the signal line, it suggests bullish momentum. Crossing below indicates bearish momentum. Rate of change, or ROC, measures the percentage change in price over a specified time period. ROC calculates how much price has changed in percentage terms compared to a previous period. It's one of the simplest yet most effective momentum indicators. When the ROC is rising and above 0, momentum is strengthening. When it's falling and below 0, momentum is weakening. Volume indicators confirm price movements and strengthen momentum signals. Strong volume accompanying price movement confirms momentum. Rising prices with increasing volume indicate strong buying momentum, while decreasing volume suggests weakening momentum. On-balance volume, or OBV, is a cumulative indicator that adds volume on up days and subtracts it on down days. When OBV rises with price, it confirms the uptrend. The 52-week high is one of the simplest yet most effective momentum signals. Research shows that stocks making new 52-week highs often continue to outperform in the following months. When a stock breaks above its 52-week high, It often attracts new buyers, creates media attention, and triggers institutional buying. A simple trading rule is to buy stocks making new 52-week highs, especially when accompanied by above-average volume. These key metrics help momentum investors identify profitable opportunities in the market. By combining multiple momentum indicators, investors can generate stronger signals and more reliable trading strategies. Section 6. Risk Management in Momentum Investing. Momentum strategies face specific risks, particularly sudden trend reversals that can lead to significant losses. Here we see a momentum trend that suddenly reverses. Without proper risk management, this can result in substantial portfolio damage. Effective risk management in momentum investing includes several key strategies. First, position sizing limits exposure to any single security, reducing the impact of individual stock reversals. Stop-loss orders automatically exit declining positions, preventing small losses from becoming major drawdowns. Diversifying across sectors reduces correlation risk, as different sectors often experience momentum at different times. A disciplined rebalancing schedule ensures your portfolio maintains its strategic allocations. Finally, incorporating volatility measures allows you to adjust position sizes, allocating less capital to more volatile momentum plays. Let's look at these strategies in more detail. Proper position sizing creates a well-diversified portfolio that can withstand individual security reversals. Stop-loss orders are crucial in momentum investing. They automatically exit positions when a predefined loss threshold is reached, limiting drawdowns. Diversifying across sectors reduces the risk of correlated losses. When momentum shifts in one sector, others may continue to perform well. Maintaining a disciplined rebalancing schedule is essential. Regular rebalancing ensures your portfolio stays aligned with your strategy and risk tolerance. Volatility-based position sizing adjusts your exposure based on a security's price fluctuations. Higher volatility stocks receive smaller allocations to manage risk. To summarize, effective risk management in momentum investing requires a comprehensive approach using these 5 key techniques. By implementing these strategies, investors can capture momentum returns while protecting their portfolios from the inevitable reversals that occur in market trends. Momentum ETFs and funds provide investors with easy access to momentum strategies through professionally managed investment vehicles. These specialized exchange-traded funds and mutual funds systematically identify and invest in securities exhibiting strong momentum characteristics. Investors can access momentum strategies through several popular ETFs. 3 notable examples include the iShares MSCI USA Momentum Factor ETF, ticker symbol MTM, which tracks large and mid-cap U.S. stocks with higher momentum characteristics. The Invesco DWA Momentum ETF, ticker symbol PDP, which tracks the Dorsey Wright Technical Leaders Index. And the SPDR S&P 1500 Momentum Tilt ETF, ticker symbol MMTM, which overweights stocks with strong momentum in the S&P 1500 index. Momentum ETFs use systematic methodologies to identify securities with positive price momentum. They analyze historical price data to find stocks with strong upward trends, distinguishing between different momentum strengths. Typically, the funds select stocks with the strongest momentum characteristics, regularly rebalancing their portfolios to maintain exposure to this factor. One key benefit of momentum ETFs is that they eliminate the need for individual stock selection. A do-it-yourself momentum strategy requires researching and selecting individual stocks, which can be time-consuming and may result in a less diversified portfolio. In contrast, momentum ETFs provide exposure to dozens or even hundreds of securities that exhibit momentum characteristics, all systematically selected and regularly rebalanced. This approach offers investors broader diversification, professional management, and eliminates the need for time-intensive research. An important characteristic of momentum ETFs is their higher turnover rates compared to passive index funds. While a typical S&P 500 ETF might have an annual turnover of just 3% and a value ETF around 20%, momentum ETFs often have turnover rates of 65% or higher. This higher turnover is due to the dynamic nature of momentum as an investment factor. Securities constantly enter and exit the momentum category as their price trends change. To maintain exposure to stocks exhibiting the momentum factor, these ETFs must regularly rebalance their portfolios, which may result in higher trading costs. Before investing in momentum ETFs, there are several key considerations to keep in mind. Expense ratios for momentum ETFs typically range from 0.15% to 0.35%, higher than plain vanilla index funds but reasonable for factor exposure. These ETFs may underperform during sudden market reversals, when yesterday's winners can quickly become today's losers. The higher turnover rates can have tax implications in taxable accounts, potentially generating more capital gains distributions. Different fund providers use varying methodologies to define and capture momentum, leading to performance differences between funds. Finally, momentum ETFs can work well as a complement to other factor-based investments in a diversified portfolio. Momentum strategies have historically delivered strong returns, but their performance varies significantly across different market cycles. Looking at historical performance, we can observe how momentum strategies compare to the broader market over time. Momentum strategies typically outperform during strong bull markets and trending environments. From 2003 to 2007, momentum delivered exceptional returns as markets trended upward. However, momentum experienced significant underperformance during the 2008 financial crisis. As markets crashed, momentum positions were heavily concentrated in previously strong sectors that fell sharply. Even more damaging was the rapid market reversal in early 2009. As beaten-down stocks rebounded strongly, momentum strategies continued to underperform as they were positioned against these suddenly rallying names. In the subsequent bull market from 2010 to 2015, momentum strategies gradually recovered as clear market trends reestablished. Understanding the performance characteristics of momentum investing across market cycles is essential for investors. Momentum strategies excel during trending markets, when price patterns continue in established directions. These periods provide the ideal environment for momentum to generate significant alpha. However, sharp market reversals are particularly harmful to momentum strategies. When markets suddenly change direction, momentum positions become precisely the opposite of what will perform well. This cyclical performance pattern requires investors to understand market regimes and potentially adjust their approach during different environments. The key takeaways from examining momentum's historical performance help investors set realistic expectations and potentially adjust their strategies during different market conditions. Let's explore common pitfalls momentum investors face and the best practices to avoid them. There are several common mistakes that can derail momentum strategies. Pitfall number 1: chasing performance too late in a trend. Many investors jump on momentum stocks after the majority of gains have already occurred. Pitfall number 2: overtrading. Excessive trading generates higher transaction costs and taxes, significantly reducing your overall returns. Pitfall number 3: failing to maintain discipline during market stress. When markets fall, many investors abandon their momentum strategy exactly when they should be following it. Now, let's examine the best practices that can help momentum investors succeed. Best practice number 1: maintain a consistent methodology. Successful momentum investors use fixed criteria and avoid frequently changing their approach based on recent results. Best practice number 2: account for sector biases that naturally develop in momentum portfolios. Without constraints, momentum strategies often become heavily concentrated in a few sectors. Best practice number 3: consider tax implications of higher portfolio turnover. Momentum strategies generate more frequent trading, which can create significant tax consequences if not managed properly. Best practice number 4: regularly review your strategy's performance against appropriate benchmarks. This helps ensure your momentum approach is delivering the expected results and allows for evidence-based refinements. To succeed with momentum investing, avoid chasing mature trends, minimize unnecessary trading, maintain discipline in volatile markets, use consistent methodology, monitor sector concentration, and regularly review performance while considering tax implications.